Thank you. No, that's very kind. Welcome to the Stiles Financial's Be in the Know podcast series. I am Paul Tickey, and I am joined by Mark Gurak, a fellow portfolio manager with me at Stiles. Be in the Know is a series of educational discussions many of you might be familiar with, where we try to keep our clients and followers of the podcast informed about current events and topics. Today, Mark and I are introducing our first in a series of podcasts we are calling Quarters and Cents. Our goal is to make sense of current market and economic updates on a quarterly basis. It's a clever name, but in the end, we hope you find the quarterly updates helpful and informative. So without any further introductions, let's launch into this quarter's discussion on Quarters and Cents. So let's lead off with the markets. The S&P had a great first quarter, up 10.5%, 10.6% to be precise. In the first quarter, it was the 15th best start of a year since 1926. Markets hit an all-time high back in January of 2022,
Right.
and then inflation kicked in, and the Fed started raising rates, and markets didn't see a new high throughout all of 22 and 23. Yet this year, the S&P has made 22 new all-time closing highs. So the question is, what's driving that? And maybe, Mark, you can dive in and give us your thoughts about what's driving these markets so far in 2024.
Yeah, so I guess initially at the beginning of the year, the thought is that the Fed was going to start cutting rates pretty aggressively in 2024. As economic data came out, that really didn't lend the Fed to come to the conclusion to cut rates. The Fed started getting a little bit more hawkish and basically communicated to the market that they weren't going to be cutting rates as much, and it threw a bunch of cold water on everybody's viewpoint. But mid-quarter, in the first quarter of this year, and as of late, we've been coming back pretty nicely here, but we're almost through earnings season for reporting through the first quarter, and earnings have been pretty good, so that's kind of helped the market rebound back to highs.
Can you give us some detail when you said hawkish? That's describing the Fed when they're in what state of mind, and then what is the opposite of
Oh, okay. A little bit of education here,
that?
huh?
Yeah.
Okay. Well, hawkish just means that the Fed wants to restrict the economy because it's running too hot, like a hawk ready to pounce on something. So they're going to pounce on the economy and try to slow it down. The opposite side of that is dovish. So think very easygoing and nice like a dove. We're going to provide lots of money for you to go out and spend and make things easy for economic growth.
So accommodating, because we
Very,
hear that
yes.
term a lot too, is
Yes.
accommodating, right?
Exactly.
So as the first quarter ended, now almost a full month and a half ago, and we're into the second quarter, that you mentioned that Powell, the Fed chairman, has been more cautious about rate cuts. Again, combination of things, fairly robust economic numbers over the last few months. So again, that hot economy
Right.
that they're trying to guard against a little bit, and inflation has started to stall as well. I mean, we talked about that internally here for a while about how that move from 9% inflation down to 3.5%, 4%. That was the easy part, and now the Fed really has
Right.
its work cut out for them to keep it moving, and that might not be necessarily keeping rates high, but right now that seems to be the very very near term outlook, and as a result, that's led to some market volatility and pressure over the last couple of months. We rode well in the first quarter. It certainly has been a little bit more choppy so far this quarter.
Yeah, one part to add to that is that the Fed will come out with a hawkish statement trying to temper expectations, and there's an immediate reaction. The market sells off a little bit, but you give it a week or two, and the market seems okay with it, and it floats back up. So it's just like you said, that's just part of the volatility in the market.
Well, and those mixed messages a lot of times, and then when I say mixed, you're right, they kind of deliver something hawkish, but always try to give you a little bit of dovish simultaneously. I feel like that's prototypical Fed speak. What is it that they really want us to take from it? I feel like sometimes they don't really want us to take much of anything from it.
Well, they want you to be okay with it, whatever they say, and they're going to give you some direction, but they're not going to give you exactly what they're thinking, what they talk about in their meetings. It is kind of one of those things. It's a data point. It's something that's out there in the market. The market absorbs it. At the end of the day, though, if companies are profitable and they're making money and they're growing, that's what's going to drive asset prices for stocks and bonds.
Absolutely. And you're right. Those triggers from the Fed, give us some visual positives or negatives, but in the end, it's really the fundamentals of the companies that will drive this.
Yep,
Um,
100%.
so if we were going to talk about, you alluded to the beginning of the quarter or the beginning of the year versus where we are now. We were looking for something kind of in that from 5 to 7 rate cuts when the year started, and now where do you think we are landed right now?
Yeah, so that was the initial thought. There's some securities out there, or basically Fed futures contracts
Right.
that will imply how many rate cuts, and that's
And we
where
look
we
at
were.
that all the time.
Yeah, that's where we were with
Yeah.
5 to 6 at the beginning of the year. I believe now we're probably at about a 1 to 2. Correct me if I'm wrong on that, but
No, I think
and then you do have this little thing that's happening in November called an election
that this year.
that is this year.
Yeah, okay.
We only have less than 6 months to go,
Yeah.
and we're gonna find out who the next president is. So
Yeah, and that could create ups and downs in the markets just by itself over that period of time. Not necessarily switching gears entirely, but as the quarter ended, markets rebounding strongly all the way since the end of October through the beginning of April, particularly technology stocks. It starts to bring this conversation along about comparing today's market with the dot-com bubble in terms of valuations and the markets of 2000 and 2001 when things got very, very frothy. Now, when you and I talk about those comparisons, we somewhat disagree with the making those comparisons, but maybe you could talk about why we feel strongly about
yeah, so back in the tech bubble, that I had literally just started my career a couple of years prior to that, so I saw how everything was built up and the frothiness in the market. A couple of stats to bring out, comparing that market to where we are currently is that in March of 2000, technology stocks were trading at 55 times forward earnings. So 55 times forward price multiple. That's very frothy.
Well, among the frothiest we've ever seen. I'm right.
Yeah, and volatility was actually very high there, but it was high in an upward trending manner.
Yeah, which is fairly rare.
Yeah, usually you see a lot of volatility when the market's going down.
When the market's in retreat.
But
right.
that wasn't the case. And well, so 55 times forward earnings back in the tech bubble. In March of this year, tech stocks were trading at about 28, roughly half, which 55 was really high and 28 is still quite high, but it's better directionally, right? And actually here, this is the real kicker to it of the comparison. If you compare the profit margins of the 2 points in time. So during the dot-com bubble, and this is just broad tech stocks, profit margins back in 2000 were about 13.9%.
Which is a pretty good number. It's not a bad number. But
yeah.
Where are we today?
Believe it or not, we're almost double that. It's, trailing 12 months earning profit margins are about 22% tech stocks.
Wow.
So you've got half the multiple and almost double the profit. So right now, although tech stocks probably do seem a little expensive, it's actually not as bad as what it was. Nobody's really sounding the bell or the alarm that tech stocks are too expensive, because a lot of the ones that tend to be a little bit more expensive than others are justified with their profitability.
With profitability, strong cash flows,
Right.
et cetera. So the tech sector is not only trading at a cheaper valuation than 2000, 2001, but it's also at a higher profit margin compared to that sector in 2000. So I think we all can agree it's not a great comparison to that dot-com bubble period.
Yeah, not at all.
If we could kind of change pace again, talking about kind of getting back to the economy a little bit, we alluded to the outlook for inflation, how it's somewhat stalled. We're the question is, where do we go from here? And we're now expecting fewer rate cuts. Is that good? Will that help suppress inflation or maybe get it back started again in a downward direction? Can you talk a little bit about what we're hearing about inflation right now? What can help? with bringing it down from now this sort of stuck at 3.5 down to the Fed's target of 2%. Maybe you could even talk about why is or what is that target in that the Fed is trying to go after there.
Yeah, I mean, I think there's a couple things that could continue to move inflation down. I think the one is just the Fed keeping rates where they are and not succumbing to political pressures to move rates down in an election year. Usually that doesn't happen, but times have changed. You know, each point in time is not necessarily a direct copy of the previous. So I guess the 2 points about inflation would be to in order to keep inflation coming down more towards that 2% Fed target would be for the Fed to keep interest rates high in order to keep that momentum with inflation coming down. But then there's another part that and maybe not everybody's thinking about all this stimulus from COVID. It came into the market, and a lot of it went into bank accounts and savings. That all that money started being spent. The savings rate started to decrease and go negative. All that money that was doled out during COVID is basically all gone now. It's spent. It's either been invested in the stock market or just spent on goods and services. So you're probably going to have a lower aggregate demand from the consumer going forward too, and that's gonna help bring inflation down as well. On the flip side of that, if spending gets shut off really really quickly and decelerates really quickly, and the Fed keeps interest rates high, well, you're gonna you're gonna see inflation come down quite quickly. At least that would be my assumption is how it would play out.
Right.
But if you get inflation back below 2%, Fed's going to take rates right back down.
Absolutely.
So
Well, and you kind of talked about two different actions that take place. One of them, when we talked about it, is monetary policy. That's when the Fed goes into action and raises or lowers rates depending on which direction they want. Inflation, unemployment, um, the economy in general to go. The other action is by Congress on a fiscal standpoint. And I know you have a strong opinion about, when rates got as high as 9%, I think you've argued, how did we let it get to 9%? In other words, why didn't the Fed spring into action earlier? But kind of give your thoughts around that and what that's led to, and also this kind of tug of war between fiscal and monetary policy.
right. So the Fed has two jobs: price stability and full employment. Well, full employment is kind of other than the very volatile employment numbers around COVID when it first started. Um, Employment's been pretty good.
Yeah.
We still have low unemployment rate. So that part has been done, or it's been handled very well. Um, the price stability part, I would say that if I had to give a grade to the Fed on how they handled that when as inflation started going up, once it got above 5 and they decided, nah, this is okay, we're just going to let it go.
What was the favorite word they kept using?
Transitory.
Yes.
Yes.
Inflation was transitory.
It was going to just.
It was only going to be around for a little bit.
Yeah, just a little bit here. It's fine. It'll go away. Just look the other way. All right. And then I went to 6. And then I went to 7. And they still did nothing. And it's just like, well, why are we sitting here doing nothing? The inflation rate is over 3 times your target rate, and you're still not doing anything. So, like I said, if I'd have to give a grade to the Fed on price stability during the, over the last couple of years, I wouldn't give them an A. I wouldn't give them a B. I wouldn't give them a C, and I wouldn't give them a D. So there you go.
So you think they failed? I think you've even used the word reckless around the office before. That they were reckless.
I would say it was reckless because if you had inflation at 5% and interest rates, short-term interest rates at basically 0, what was 0.25% going to do? We still actually had real economic growth, so there was no reason to believe in the transitory nature for as long as what they did.
And what do you think a solution might be? we've been hypothetical about this. What do you think? What do you think the solution?
Basically, you take away the interest rate mechanism away from the Fed and let free markets prevail.
Well, we've also just talked about, hey, why don't these two parties get in a room together and hash it out, right?
Well, yeah.
Let's
Well,
figure out what one is doing. Well, what one hand is doing while the other hand.
so now you're talking about the monetary or the fiscal part of it as well.
Yes.
So with Congress, right? So yeah, that one's trickier because there's different motivations by the two groups,
Yeah.
right? So the Fed President Powell and the rest of the Fed governors, they have their two mandates. That's how they're created. Congress, they want to make sure that the economy stays moving so that uh, their constituents have jobs and they vote for them.
Right.
Where we're at, economic wise, the easiest way to do that is spend more money to create more jobs.
Right.
Um, so that's where this tug of war comes
Or
from.
keep the economy afloat, so to speak. So yeah, it doesn't it's not even a party decision. Winning votes is most politicians' goal.
Right.
Let's face it.
Yeah. And that's not a partisan statement because Democrats spend as much as Republicans spend. They just spend it different ways.
Yep, for sure. So let's switch gears again a little bit because I think we've kind of knocked inflation to death here. But the housing market is another part of the economy that's worth discussing as well. And, we've had some pretty astounding construction activity that remains pretty strong despite the higher rates. So what gives there? What's the reason for? Because everybody thought, with higher rates, we might see a stall in construction. But what's going on there that you see, or how can you explain that?
You need to go back to the last recession we had, the Great Financial Crisis, around 07, 08. Just prior to that time, interest rates were extremely low. People were buying 3, 4 houses, mortgaging at 100% of the value, and renting them out, and just thought that price of housing always goes up. Well, we found out that isn't always the case. And during that time, you had a lot of people lose a lot of money in the real estate market. When that demand for housing goes down that dramatically, you have a lot of people that were working in those industries find something else to do. They left the industry and moved on to something else for work.
Right.
The anecdotal evidence I can give to that is back during that time, a couple of clients that I was working with were construction companies. And it was probably around about 2012, 2013. I remember having a conversation with one of these clients, and they said they could build twice as many homes if they could just find the labor and skilled trades workers to do the work. But they didn't have enough foremen who could run a safe construction site. They didn't have enough drywallers, rough carpenters, finish carpenters in order to do all the work that needed to be done. So we ended up getting some price inflation, general price inflation in housing. But the problem is all those workers, they left and they didn't come back. And now in the U.S., most high school graduates don't go into a trade profession.
Right.
They go to college and take another route, right?
Right.
So the workers that left weren't replaced. So that's why, if you need to have a remodel done on your house and you get a bid, that's where part of the sticker shock is coming from.
And that's easy, right? Most bubbles, because we're talking about a housing bubble back in just prior to the GFC, the Great Financial Crisis. That always results in a big correction, but wouldn't you agree that it's almost always an overcorrection? And so then we're left with this scenario that you described: not enough workers, and now maybe not enough houses that have come about from that, which is remarkable given we were overhoused or we had too much housing. So what's happening now? I mean, you've got that sort of incentive or impetus. What else is driving now this housing need?
Yeah, well, now you have Gen Z and millennials that are starting to get married, starting to, form households, have kids, and the housing supply isn't there. So if you have a really good professional job, you can buy a house, but those who, maybe some people in that cohort that don't have the resources, they're not able to buy a house. Well, what do? You have to rent them. So, I've seen it, around the Twin Cities metro area, but there are tons, tons of multifamily housing projects going up.
For sure.
Um, so I mean, that's one indication of them.
It's kind of a build to rent phase
Right.
that we're going through. But if you described a scenario in which home inflation is occurring, the price of housing is increasing, and you're a current homeowner, why aren't you selling in that higher priced market if it's so attractive now for housing?
Well, the good thing is if you're fortunate enough to refinance your mortgage back when rates were low, and you got somewhere around 3%, give or take, right? Um, if you sell that house, your mortgage doesn't go with your new house. You pay it off and it goes away. So you need to buy another house at current mortgage rates,
Right.
right? Well, we're sitting at around 7%. That adds a huge cost to your mortgage.
Well, more than double, right? I mean,
Right.
conceivably, if your house is the same price.
Yeah. So the only way that it makes sense is if you have enough equity built up in your house that if you sell your house, you take that equity and you pay cash for your next house. And in some instances that'll work. You may have some baby boomers who want to downsize, drastically. Maybe they had the big family house, they had 4 kids, real big house, they don't need it anymore. They'll downsize into 2-3 bedroom house, and maybe they've owned it a long time and they can actually pay cash for that next
But that
house.
doesn't work for everyone, right? I mean,
No.
that's the point. Is when I was describing, I was being somewhat facetious. If the price of houses is up so high, why aren't people selling? And your answer is, well, then if they sell, they've got to whatever they go into in a new house, they're paying a much higher cost because of the cost of capital.
Yeah. So there's basically there's a supply limitation, and that's why for people who want a new single family house, it has to come from builder. So yeah, it's there's a lot of things that within construction, especially within housing, that is just driving the prices higher.
So if we think about a house being, the consumer's probably most valuable asset for most people, you've got a high value to that asset. We've talked about unemployment being relatively, historically low. With that backdrop, you mentioned savings rate maybe being down or even negative. But in general, would you say that the consumer is in good shape? What is the thought on the consumer right now?
It really depends on what type of consumer you're considering. If you're taking the top quarter of wage earners, they're almost always going to be fine, and they're going to keep on spending and living their lives as they normally would. Inflation isn't that big of a drag on their earnings. If you're talking about people who are in that lower half of the income stratification within the country, every bit of inflation that cuts into added housing costs, bigger bill at the grocery store, can't go out as much. Everything costs more, and it eats into that budget even more.
Most workers have seen wage inflation. Why isn't that enough?
Yeah, well, wage inflation has been less than price inflation, so
That's a problem.
yes, that's a big problem
So
because
even though your income is going up, so are your expenses.
exactly, it's a real problem. So that's part of the reason why I would give the Fed in not stellar ranking and
Give them an F again.
beat up the Fed again. Well, Fed does start with
With an
F,
F, yeah.
so it makes sense.
Yeah, it seems that there's more reasons to find they didn't get it right than ways to find that they got it right.
Yeah.
So you've got this backdrop. The consumer is lacking confidence. I feel like for the last several years, it's been because of this inflation environment. The consumer just doesn't feel good when prices are high and their own wages aren't keeping up. So lower savings rates aren't because of a willingness to spend, which would suggest a confident consumer, but instead lower savings rate is a necessity to spend. I mean,
Right.
you kind of alluded to that. It's not, oh, we're not saving because we love to spend. It's because they have to spend given the high inflation. What about, inflation come down the core when we talk about core inflation. But when we really think about it, what is keeping inflation sort of frothy right now is is energy prices and food prices. Do you have any thoughts about that, and how, what's keeping oil prices high and maybe heading higher?
Yeah. So oil has come down a little bit as of late. A couple weeks ago, I think we were at about $80 a barrel. We're somewhere down in the 70s now. Um, so that's getting a little bit of relief.
That's good.
But we do have international conflicts and disagreements in the major oil exporting countries in the world, and that's what usually keeps those prices high, just from elimination of production, or you know especially if there's a war going on in a certain part of the world. Um, those sometimes those facilities go out of operation for a little bit. So, and then you have general economic warfare between countries that are having disagreements. One being, I know Russia wants to decrease their supply, so the world still needs a lot of oil. Where's who's going to pick it up, and who wants to pick it up? Because if you could just get paid more for the oil that you pump out of the ground without having to actually produce more, if you're feeling pretty good about that, if you're Saudi Arabia or
For sure.
one of those countries in
And
the
what
Middle East.
we've been describing lately is, relatively full employment picture, at least here domestically. A consumer that's in pretty decent shape. So when you think about the price of oil, it's a supply and demand story. You just described supply is a little bit tight because of the conflicts in the Middle East countries, and demand hasn't let up because we've got still a pretty healthy consumer. So you combine strong demand with low supply. I don't know how you can expect prices to not stay elevated.
Yeah, and another thing to add to that is the U.S. actually, in order to try to, um, I guess, make it easier on the consumer, they released a lot of oil out of their strategic petroleum reserve.
Um, but one other thing, because we alluded to housing, which I think about more from the residential side, more from the consumer side, but let's last focus on the commercial real estate market. When interest rates were low pre 2020, commercial real estate was an attractive place to invest. Fast forward to COVID, or fast forward to rather the Fed raising rates and interest rates being high, the COVID effects that you mentioned about, not just construction workers, but the COVID effects it had on workers working from home, et cetera. What's that meant for the commercial real estate market? And maybe you want us to talk more specifically about the office market.
Yeah, so the office market, you've got a lot of real estate investment trusts that solely concentrate on the office market. Those types of securities are not ones that we're concentrating on these days. We think there's better options, but you're starting to see some large buildings being foreclosed on. There was one in Minneapolis not too long ago, LaSalle Tower downtown. I think originally it sold for, I guess, the pre-COVID price. It sold for like maybe 130, 140 million dollars. The owner then sold it for about, I think it was 30 or 40 million dollars.
Well,
So I mean, that was a huge haircut.
yeah, almost
Um,
80%.
yeah, and most recently, I saw an article of a big office building in Fort Worth, Texas. It sold for about $130 million 3 years ago. So actually, it was right before COVID. It went into foreclosure. It just sold for 12.3 million.
Whoa,
So that's more like a
90, yeah,
90%. Yeah,
90% plus.
yeah. So there's probably going to be more pain before we get down to actual market prices. Um, because I don't know, how many people do you know go into the office more than 2 days a week, other than us?
Not many. I mean, most of the professionals I'm around do have that option of working from home, and so you're right. That puts stress obviously on the real estate market, commercial real estate, office properties in particular. Can you talk a little bit about how that puts stress on kind of the wider financial system as well? because if there's foreclosures, if there's people inability to meet rent or leases on these properties, who's another tangential sufferer of that environment?
Well, I mean, that's the investor in the building is going to be hurt. They're obviously going to lose money.
And the banks, right?
Yeah, the bank there are a lot of banks that provide financing to commercial real estate projects, and it's not necessarily the big banks. It's more the smaller or mid-sized regional banks. We've seen some bank failures, over the last year that fit that stratification of the banking sector. There was Republic Bank, there was Signature Bank, there was I'm missing one. Oh,
Silicon Valley.
yeah, Silicon Valley. Now there were some other reasons for that, for those failures as well.
Well,
But
you started to say when I first asked that question, I didn't mean to make it sound like a trick question about the tangential stresses on the financial system, but you started talking about investments and investors. Can you maybe, without sounding like a plug to our portfolio management process, but I mean, we kind of dodged a bullet there, wouldn't you say?
yeah, we're not necessarily a big fan of banks, just because of all the leverage they have to take in order to create their net interest margin and profitability. Especially in regards to regional banks, they don't have a very diversified revenue base. Some other fee income. A lot of regional banks might have some insurance business that they do, some investment business, but it doesn't. It's a small part of the overall operations of
Right.
those regional banks. So that is one reason why we don't like banks. And I guess for financial exposure, we prefer stock exchanges, insurance companies,
Well,
and
companies that have, are a bit more stable and with better cash flows,
yeah,
frankly. More predictable cash flows
yeah,
is maybe the best way to put it.
not as levered. Yeah.
And then when we think about, how we invest in real estate, and specifically publicly traded real estate investment trusts, how do you feel we've done in terms of avoiding that office space debacle?
Yeah, well, I think we've done pretty good. I guess a lot of the real estate exposure that we have clients in is actually in storage companies, mini warehouses,
Right?
or there are some REITs that specialize in just owning cell towers
Yep.
and leasing out the spot on the tower to transmit signals. I don't think anybody can argue that cell phones or digital transmission over the airwaves is going away. So
No, in
uh,
fact, it's probably going to accelerate, which kind of brings up, one of the hot trends is artificial intelligence and AI. So talk about how we play that on the real estate front.
Well, you have to have physical data centers to handle all that traffic and analysis and data storage. So there are very large buildings throughout the world that have lots of computers. They need to be cooled. They suck a lot of energy, and there's really high demand for that type of property right now. And those properties are fairly profitable. So.
Well, that's a good way to finish. That's all we've got for this quarters and cents. We hope you enjoyed our first episode, and we hope that Glenn is very creative in his editing capabilities. All right, bye-bye.
But
Stiles Financial Services is an SEC fee-only RIA in Minnesota. Information presented is for educational purposes only. No listener should assume that any discussion or information presented serves as the receipt of or the substitute for personalized advice from Stiles Financial or any other investment professional and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Stiles Financial Services is not a law firm or accounting firm, and no portion of this program should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific needs.